Hey everyone, today on the final bar, I'm joined by Roman Bogomazov from Wyckoff Analytics. He'll share with us his take on a key cryptocurrency space and how to think of it from a Wyckoфfian perspective. The overall market environment I would describe as choppy. We've had quite a bit of accumulation recently. Today, you really get the yin and the yang of the markets, right? The equities that are working, things like NVIDIA breaking out, and the things that are not working, things like Facebook breaking below their 200-day moving average. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of stock charts, using data visualization techniques to represent market dynamics, investor behavior, and quantify what all of these investors are thinking, how they're voting with their capital, to put it a certain way. You know, I tend to think of the market in terms of phases of accumulation, distribution, and consolidation. I think you can boil things down into one of those three phases. And depending on your time frame, you may describe things as being in different phases, depending on sort of your overall perspective. And talking with Roman Bogomazov here before the show started, I think you'll get a sense of looking at a bit of a longer term view and taking a big picture view of something like Bitcoin. It's so easy, especially in a volatile asset class, a volatile chart, to get drawn into the short-termism, right? Drawn into what we call the flickering ticks of the short-term dynamics. Let's take a step back and focus on how the short-term movements fit into the long-term. And I think on a chart like Facebook, for example, it's a really good example to do that. This is the time to make sense of this pullback phase, make sense of a breakdown of the 200-day and what the overall structure actually is telling you about the environment. We have great guests on the show. I'm excited to talk to Roman here in a few moments. Coming up tomorrow on Wednesday, the 27th, we have Pat Seresna from the Market Huddle podcast. On Thursday, Doug Bush from Chart Smarter is joining us. He's a fantastic stock picker. Next week on the 2nd, we have Joe Rabel from Rabel Stock Research. He's the host of Stock Talk with Joe Rabel, really good Q&A based show on StockCharts TV. Also, as a reminder, tomorrow on Wednesday, the 27th, our latest episode of The Pitch. If you go to stockcharts.com/the pitch, you will see this monthly stock picking showdown, 3 different experts. Tomorrow we'll be joined by Grayson Rose from stockcharts.com. Each of them will present 5 ideas, then they'll debate and discuss them as a group. It's a lot of fun. I've hosted it a number of times. It's always a pleasure to bring in some different perspectives and see what similarities we can tease out. So go to stockcharts.com/the pitch for the latest episode of that. And also all of our previous discussions. You can see what our experts have thrown around, what the stocks have done since those discussions. Let's continue on with our market recap. So I mentioned it's sort of a choppy session. We finished out net positive for the S&P, up about 0.2%, closing just below 45.75. But overall, it was a choppy segment. We got almost to 4,600 earlier in the day, and then chopped around the remainder of the day. Certain things were down, and so the mid cap index actually finished down on the day. Small caps, the worst of the bunch, down 0.9%. The Nasdaq 100 up 0.3%. So we're back to that sort of familiar scenario where certain equity indexes up, certain ones down. That's differing from previous sessions where everything's been up and it's just varying degrees of bullish movements. This is a little more mixed day, and the S&P was higher while the VIX was actually higher too, which is a little unusual when we think about the movements. Plenty of stocks that were down, so that makes sense to me. VIX is back just above 16, by the way. Other asset classes, very quick. Interest rates continuing their pullback of sorts. If you look at the 10-year yield, just above 160, just below 162, that is. The dollar index is up 0.2%. And we're going to talk a little bit about the stronger dollar environment. The UUP has been kind of chopping around there. But overall, if you look at the long-term trends, it's been stronger dollar and it's been U.S. stocks over non-U.S. stocks. And I think that theme certainly appears to be continuing, at least today. Gold and silver down today, so the relatively defensive side of the commodity space. The gold trade down 0.75% or so. Oil prices up a little higher today, and the energy sector was the top performer of the 11 S&P sectors, as we'll get to here in a moment. Cryptocurrencies, sort of mixed, actually, to be honest, with the larger coins that we follow, particularly Bitcoin and Ether, both down today, with Bitcoin down about 0.2%. Now, it's got up to around 67,000, finally broke above all-time highs at 64, 65,000, continued up a little bit further, and now back down a little bit, sort of right at that 62,000 level. We talk about the importance of getting above 60,000. Those big round numbers have been very meaningful, and I would continue to eye that if you get any sort of further pullback. Again, my guest today, Bogomazov, will talk a little bit further about the price of Bitcoin. Let's look at a chart of the S&P 500. We'll come back and look at some of the other charts. So interesting day today. If you look, the market overall finished on a positive note. You could describe this day, depending on how particular you want to be with your candle patterns. You could actually call this chart of the S&P what's called a shooting star pattern, which is you open at a certain level, you trade higher, you close back at the lows of the day. That's not overall a super constructive pattern to be had. If we look at the spiders, it's a little different because we open in a little different way. The opening values on indexes are a little weird, so I try not to read too much into candle patterns on indexes, because the opening prices for the longest time are preset, right? So different indexes will have a prescribed way where they set the opening value, as opposed to like the spiders or a futures contract where it has an actual open outcry sort of open, where you're looking at where the prices, where the buyers and sellers are actually coming together. So I don't know if I'd read a ton into that, but certainly the fact that we closed down at the lower end of the day is not short-term positive. However, the longer picture is this: we have broken to new all-time highs in the last week. As long as we remain above 45.50, it would be difficult for me to think anything but constructive about stocks. When we would start to break down through there, if and when we would break back below that 45.50 level, I question a little bit about the tactical time frame, but overall the long-term trend has been fairly constructive, right? I think over the last 6 to 7 weeks, we've seen quite a bit of a rotation. And, I saw plenty of warning signs here in mid to late to September, as you saw, the S&P making new swing lows. You saw the S&P getting back below its 50-day moving average. But as we talked about, what were the conditions that would tell you that the downtrend was going to be limited in scope of price and or time? And it was getting back above the 50-day moving average, putting in a higher low, putting in an RSI above 60, all of those things, making a new high, all of those things we've now done. And so I think, when you look at the market environment, I would love to tell you with perfect foresight where the highs and the lows are going to be. I would say if you think of technical analysis like that, you're going to be frustrated a lot. What I think of it is trying to understand the trend, particularly the longer term trend, trying to understand the cyclical and the secular and the tactical and how those timeframes relate to one another. And when a market's making new all-time highs, I would tend to give the benefit of the doubt to that uptrend. So at this point, the S&P is making new all-time highs. The RSI is in a bullish phase. It's in a bullish range, getting above 60 on a rally. And overall, that points to fairly constructive tape. When you're thinking of the S&P, the other thing you can do is look at breadth readings. And we've talked about some of these recently, but the main one I would highlight today is the advanced decline line chart. So this is one where you're looking at whether or not these advanced decline lines are confirming the new all-time highs in the S&P. And what I'm looking at here, I don't know if these are all registered through the close today. Probably not. It usually we update the data here after the close, and so I don't believe these are updated yet through today's trading just yet. This looks like it's updated through yesterday. We're very, very close to confirming new highs, at least getting above the September high for all 4 of these cap tiers. And so I think watching that this week to see if the advanced decline lines are able to make new highs could be a very telling indication as to whether or not it's a broad enough advance to support higher highs from here in the S&P. Looking at sector rotation, actually I had kind of a defensive feel to much of the day. Utilities and real estate were at the top of the list or near the top of the list for most of the day. Energy at the end was the top performer with the XLE up just over 0.5%. But on the downside, you have communication services. Now this is Facebook's sector, which has had a pretty rough day. This is after yesterday we talked on the show about that bullish engulfing pattern did not materialize, and we'll show that chart here in a moment, and how I think you should think about that. Industrials also lower today. So, it's interesting. You had kind of a mixed bag. You have sort of the leaders and the laggers, or the winners and the losers, the outperformers and the underperformers. And I think if you're looking at a set of stocks or a set of ETFs, I would focus as much as you can on that relative performance line, that relative strength line, because that will tell you whether or not this chart that you're looking at is getting it done on a relative basis or not. A couple of stocks to highlight. Regeneron and Facebook are two we'll do. Regeneron is a stock that's oversold as it hits its 200-day moving average, and now rotating, finding support at the 200-day and rotating a little bit higher, reclaiming the lower end of that gap from the end of September, beginning of October. Still a lot to be left here, but this could be setting up for this incredibly broad and constructive what's called a cup and handle pattern, which is a big rounded bottom. You have a resistance around the same level. You then have a secondary pullback. You retest that same level. You'd have to get all the way above 680 to validate that. But I like the fact that it's rebounding off of the 200-day moving average. It's actually kind of encouraging. You compare that chart to this one, which is the chart of Facebook, which is actually doing the opposite, given the opportunity to rally off of the 200-day moving average as it's oversold approaching those levels. It's actually dropping today. Now, it was down over 5% earlier in the day. It bounced up a little bit toward the end of the day, but still down 4%. Now, what I was taught, and going to the candle chart here very quick, we'll update this because we spent a little bit of time on this yesterday. I met with Steve Nissen a long time ago. He wrote a number of the books, sort of the books on candlestick analysis. Japanese candlestick analysis, I think, is the name of the first one, and Beyond Candlesticks was the second one. Those are some of the first books I bought on technical analysis after John Murphy and Martin Pring's books that many of us read as our first ones. And if you look, we talked yesterday about the bullish engulfing pattern, which is a down candle, an up candle, and similarly, we had a hammer candle hitting the 200-day moving average. Overall, that should be a short-term buy signal. But when you're looking at a two-bar pattern like this, the bottom, the low of that pattern should be the stop. That should be the point at which it tells you that the candle did not play out as expected. You want to unwind that trade, or you did not get a confirmation signal that the pattern was correct. So today, closing below the lower end of that pattern sort of invalidates that bullish engulfing pattern. I think puts Facebook overall still on a bit of a defensive side. But again, you're looking to find some sort of floor. You're looking to find some higher low. At this point, getting below the mid-October low, we're not seeing it today. So Facebook now continues to be in a tactical distribution phase. We need to take a quick break. We'll be back with my guest, Roman Bogomazov. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Really appreciate you joining us every weekday after the close for our show, recapping the market environment using technical analysis. A couple quick comments before we get to today's guest, Roman Bogomazov. First off, we'd love to hear your questions, and particularly questions that come up as you were analyzing your own charts. What questions are you running into as you were trying to make decisions using stock charts and using technical analysis? Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Just put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer yours live on the air in our next mailbag segment on Friday's show. Also, as a reminder, go to StockChartsTV.com. That's our on-demand platform. So much great content every trading day, and even sometimes on the weekends. Great educational content, market-oriented commentary, helping you make sense of things in uncertain times. Go to StockChartsTV.com, or on any of your mobile devices, search on the App Store for StockCharts TV on demand. I want to welcome on today's guest, Roman Bogomazov. Roman is the founder of Wyckoff Analytics based in the San Francisco area. He's been on the show before, always does a great job of representing what is called the Wyckoff analytical method, which is a what I can think of as a structured way of making sense of market dynamics. Roman, welcome back to the show.
Thank you, Dave. And as always, really happy to discuss markets with you.
So we are going to focus together on the cryptocurrency space, particularly in Bitcoin. I think obviously a lot of attention, well-deserved on Bitcoin recently with a move above all-time highs, making new all-time highs above 65,000, pulling back a bit. But help us make sense of the overall structure. How are you thinking of Bitcoin here?
I'm going to start with the sentiment, because the most recent drop from 64,000 to about 29,000 has produced such a bearish sentiment. Yes, it's back in April, May. And there were quite a lot of people that were thinking that the Bitcoin is done and we are not going to go up anymore. We are going to instead go down to maybe 10,000 and so on and so forth. So a lot of those people were either in the bears camp or were in the bulls camp that did not come on board at the correct time. And therefore, they did not jump on the last rally. The last two rallies are having kind of like momentum signature, momentum characteristics. So a lot of people missed out on this opportunity. And the whole message that I have today with Bitcoin charts is that there is plenty of opportunity ahead because the long-term structure and the long-term trend are still up. If we look at the origination of the whole long-term secular move that the Bitcoin is in right now, we see quite a big causality from 2018 going into the COVID low, where we have a shakeout into phase C. This is a Wyckoff term. This phase C usually identifies the absorption of supply by big interest and the beginning and the emergence of the uptrend. And we see quite a nice stride to the upside. We see that the volume signature increases represents a lot of institutional interest that comes into the market. And then during the most recent major backup action, we see how supply is decreasing. And even though we have produced the volume spike there in April, May action, but overall supply has decreased and the price started to go up. So that is suggestive of the continuation. So the second question that we have is for how long, or what are our targets, what are our objectives that we might have? And for that, we use in Wyckoff the PNF horizontal count. So you've mentioned candlesticks. Today, I'm bringing something different, PNF horizontal counts. So here you see the Wyckoff-ian way of calculating the horizontal counts from the PNF structures. And your comment before the show was how clearly we could see the structure here with this PNF chart. Please note that the box size, so each box represents 10% of move, which is just incredible because Bitcoin and just cryptos in general are just so such big momentum movers. You have to use, the big size. And we have certain, kind of like ways of calculating the percentage counts. So as you could see, our conservative count brings us to this major sign of strength high into 3146 area. And there we start our deceleration of the momentum. This is where we're in the vicinity of the target where we might have a consolidation. And what a beautiful count that was, because it kind of points us to the area of, maybe you call it a short-term weakness. And then we go through the major backup, which appears to be a reaccumulation. So we start using these blue counts and green counts, much larger counts. So what do those counts tell us? The story of continuation of a major uptrend where our targets could reach over 100,000, over 200,000, and in some cases, the targets are showing even above 400,000. And I truly believe that within the year or two timeframe, we will be able to get there, because once the trend is on, as Dave, this, from the technical analysis, especially the long-term trends, this cyclical trends, those have the tendency to stay because institutions don't go in and get out right away, as like more weak hands holders do. They stay within the trend for a long duration of time. And then I want to point your attention to something of a stupid count, something of a stupid target, which is at 1,400,000. Do I believe that we could get there? Absolutely. The way how Bitcoin behaves, the way how the causality has been created, the way how institutional interest is developing, the way where the macro economy of the crypto space is going, we could get there, but it's going to take some time. So I think that the main message from me today is know your objectives, long-term objectives, know your long-term trend, and stick to that instead of trying to figure out every single small move every day. Dave?
I love that take, Roman. There's so many little nuggets of investment wisdom in your last description there. And it's funny, as you talk about some of these more aggressive upside targets, 5, 6 years ago, some of the current price levels seemed equally as absurd, I think, in a lot of ways. So I have learned not, especially with cryptocurrencies, not to get too put off by a number that seems kind of crazy, because what we've learned is there's a lot of things that become possible given the proper time frame. Ramon, listen, it's awesome to get you back on the show as always. Really appreciate you talking through some of this analysis, giving us an appropriate long-term perspective. Be well, stay safe down there, and we'll talk to you again soon.
My pleasure as always.
That's Ramon Bogomazov. Ramon's the founder of Wyckoff Analytics, and what he described using these two charts is a great illustration of, I think, just a part of what I would call the Wyckoffian method, which is, really giving a structure to the markets. And Ramon does a great job of representing Wyckoff and his, the pioneering way of thinking about market structure. We have Bruce Frazier, who does a great job of talking about Wyckoff analysis on StockCharts TV. And I think all of us, Ramon, Bruce, and I all consider someone like Hank Pruden a great mentor who really, really did an incredible job of spreading Wyckoff's wisdom to many in the investment community and individual investors as well. Let's continue on today's show with the Final Bar mailbag. As a reminder, our email is thefinalbar@stockcharts.com. We're here to answer your questions anytime. Keep them coming. Let's get to your first question. How do I set up the charts to show the micro window that Erin Swenlin features on her show so I can actually see the crossover for PPO, PMO, and MACD? You mentioned Erin Swenlin. She does a great job with a number of shows, actually. She hosts Decision Point. Often you'll see an appearance from Carl Swenlin, her father, who's an incredibly talented analyst. They both really are. She also co-hosts Chartwise Women with Marielle McGonigal, which just was relaunched couple weeks ago, and it's really, really beautifully done. So I'd encourage you to check her out in both of those spots. You mentioned the little preview, and I'll show you what you're talking about. If you look at one of these charts, a lot of times the current data can be a little hard to see, especially if you're looking at a little longer term time frame. So what you're looking for is below the chart, there's this little guy that says Zoom thumbnail. And if you click that on, you'll probably see that on some people. People like Erin Swenlin use this. Greg Schnell, if I remember right, uses this. Sometimes what it does is it basically zooms into the most recent data, and it gives you like a little, blown up thumbnail, a zoomed in thumbnail of the most recent data. And what it does is it helps you just see the particular signals, focus in on particular levels. It allows you to look at a long-term chart on the left, but focus in on the short-term action on the right. And that's how you do it. Click on zoom thumbnail there. I don't actually use it very often in my own charting. And every time I see someone use it, I wonder why I don't use it more often, because it really does make the chart easier to read. So that's what you're looking for. Question number 2, I wanted to ask if there's any reason behind consumer discretionary's upward move. It's one of those sectors who tend to react negatively to higher interest rates. So how can it be so overextended? Your question is really, really good. And I wanted to address it only because I think there's a lot of interesting ways we could take that one. We don't have time to debate all of the nuances of your question there, but I would tell you a couple things. Number one, I would hesitate to oversimplify. So what you're saying is rates are probably going higher. They certainly have been going higher. Consumer discretionary doesn't tend to do well in that environment. So how can consumer discretionary be going higher? And I would remind you, interest rates are just one piece of the puzzle, right? When you think of macro inputs, you have, elections, you have geopolitical issues, you have infrastructure spending, stimulus spending, the consumer confidence, the coronavirus, and then you also have things like interest rates and inflation. But it's not all about interest rates. It's interest rates along with all those things. So if the coronavirus pandemic would explode once over again, all of a sudden we have economic shutdowns, which certainly are a possibility of some small probability, I would imagine. It doesn't matter what interest rates are going to do. That's going to be the story, right? That's going to be the macro theme that I think a lot of stocks would trade off of. So I would hesitate to draw too many direct lines between something like interest rates and consumer discretionary, because I think there are a lot of things on there. So Tesla blows out to new all-time highs because of things like headlines that, Hertz is going to order hundreds of thousands of electric cars. And that's going to be a tailwind, certainly, to Tesla's business here going forward. Those types of headlines are happening along with all these other market movements that you're having. So the reality of consumer discretionary, here we're looking at the XLY versus the XLP. And we're looking at the equal weighted version of that at the bottom. So consumer discretionary has been broadly outperforming the consumer staples sector. If you look at the XOY, you can see that that sector has been breaking out as well. That sector is dominated by three stocks: Amazon, Tesla, and Home Depot. Two of those two stocks, Home Depot and Tesla, are both breaking to new all-time highs in the last week. So that's the chart of Home Depot. This is the chart of Tesla. So those two stocks, along with Amazon, which granted is not nearly as attractive as those, but has had a nice rally in the last couple of weeks overall. Those three stocks are almost 50% of the XLY. So if they're doing well, the sector as a whole does pretty well too. So the RCD is an equal weighted ETF. That can give you a little clearer read on the average consumer discretionary stock, not just Tesla and Home Depot and Amazon, but sort of all the other names as well. So I think that's what I would be looking for. It's a lot of things other than interest rates. So, in general, I think you're right. Higher interest rates probably not great for consumer discretionary, but stocks within that sector can do just fine regardless of interest rate policy. And it has to do with some of these other headlines that you're going to come into. Also, we're in the heat of earnings season, which is a big part of that thesis right now. Last question, then, boy, you have to wrap. Tesla seems overbought and creating an island. Is that true? Does that mean it's ready to correct? We just had this chart up, so let's bring it back. Is that an island? So really interesting question here. So if we look at maybe a shorter chart, maybe just like a 1 year chart. So this is what the chart of Tesla looks like. And you're asking about this jump higher. So an island reversal actually needs two parts of that. So you can't actually call a pattern an island. An island is where you basically have a gap higher and you have some trading, and then you have a gap lower. So it's called an island because it's sort of like looking at like looking straight down on a map, and you have an island surrounded by water. So there's a gap between the island and the mainland. That's kind of what the chart would be doing. So to be an island pattern, island reversal pattern, you actually have to have a gap down, which takes us back down to this previous level. And then you have that price action that's sort of stranded from the rest of it. That very much is an island reversal pattern that is fairly negative. You can't really call it an island pattern until you get that second gap lower. So that's the description of it. How do you interpret the action in Tesla is what you're talking about. And I would say the fact that we're extremely overbought is one piece of evidence that I would be looking at. When something's extremely overbought, that usually means there's so much positive momentum, you're probably going to get at least one more move higher, after you get some sort of pullback here. So given the drop we had today, finishing more toward the lows, maybe there's a bit of a short-term pullback, but overall, the fact that the RSI has been above 80 overall tells you there's a lot of strong momentum. And I think that still is the story overall for Tesla. The last is just the exercise in gaps. And, you've had a big run higher and then this big gap here. So the lower end of the gap around 950 would be an important, or sort of the upper end of the gap, the lower end of yesterday's low would be something to look for. Holding 950 would be a key part of that Tesla's still constructive thesis. We start RSI coming back out of the oversold region and the price of Tesla getting below 950, gapping lower, which would make it an island reversal. All of those things would tell me that the rally in Tesla is kind of exhausted. At this point, it's overextended, but stocks can remain overextended for quite a long period of time before they correct downwards. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the U.S. versus the world. I mentioned the stronger dollar thesis, and this is the chart of the U.S. dollar here at the bottom. While it's had a choppy run for sure, if you look at the dollar index year to date, overall, it's much stronger than it was at the end of last year. And the U.S. has been outperforming non-U.S. stocks. Or here I'm actually looking at U.S. versus world. So SPY over ACWI. You can see this is actually making new highs this week. So it tells you overall, you're better off as a US-based investor keeping your capital close to home until that chart starts to turn lower. Chart number two is Apple. There's so many stocks reporting earnings this week. I think tomorrow we'll hopefully make time for a segment focusing on some of the earnings charts and some of the key names to pay attention to. But Apple is one to pay attention to reporting this week. Many of the FANG stocks reporting this week. But right now, Apple's in a bit of a range. And I think if you look, Apple has been range bound before. And the way that this stock break tend to be a really good read on the overall market conditions. So at some point, Apple is in the middle right now of the range from 156 on the upper end, 140 on the lower end. I'm interested to see if the earnings this week provide enough of a catalyst to break it out of that range. But I would be compelled to follow that momentum depending on which way that breaks out. Finally, we have Regeneron. I mentioned this is potentially a big cup and handle pattern. You can't call it that until the handle becomes a little more developed. But I like the rally off of the 200-day moving average. Compare that to the chart of Facebook, which has been struggling to rally off of the 200-day moving average. In general, stick with names that are demonstrating their ability to rally off of key support levels. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Ramon Bogomazov joining us from San Francisco. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.